Hello, welcome everyone. I'm Terry Ryder, founder of hotspotting.com.au. My guest today, Miriam Sankour, has observed that investing in property is Australia's favourite way to create wealth, and that, unfortunately, it's also our most common way to lose money. And here at Hotspotting, every day we receive cries for help from investors and home buyers who have made bad choices in real estate. So I'm delighted that we're able today to present a webinar on the topic of 7 common mistakes property investors make. And I'm especially pleased to have Miriam as our presenter because I think her book, Property Prosperity, is one of the very best real estate investment books that I've read. Miriam's the founder of Property Maven. She's a licensed buyer's agent, an accredited property investment advisor, and a best-selling author. She has nearly 2 decades of professional real estate experience in 2 states, and she regularly features in state and national awards for buyer's agents, including being named the National Buyer's Agent Runner-Up in the Your Investment Property Magazine's Reader's Choice Awards for 2014. She's a regular media commentator. Her articles are widely published across Australia. She appears regularly on programs such as Channel 7 News, the 7:30 Report, Sky Business News, and the radio station 3AW in Melbourne. If you have any questions as you listen to Miriam's presentation today, please type your questions into the panel on your screen, and we hope to have time to deal with as many as possible of those questions towards the end of the webinar. So Miriam, one of the things that's clear to me in speaking to you often is that you are passionate about protecting investors and ensuring that they're not misled in the buying process. And that's really the essence of your topic today, is it not?
That's correct, Terry. Thank you very much for that kind introduction, and thank you everybody for attending the webinar today. I appreciate you taking some valuable time out of the day to do so. So I've got some great content to share today, and I'd like to impart as much value as possible. So I will offer an opportunity at the end to take away some additional free resources, including, I suppose, an ebook version of the content of the presentation today. So as we roll along, I'll obviously talk to that. So I just want to note that throughout the presentation, we're not providing tailored financial, tax, legal or property advice. And I strongly recommend that you seek independent accounting, legal, finance and property advice from an expert before embarking on any information disclosed in this presentation. And again, the legalese: by attending the presentation today, you agree to release, indemnify and hold harmless all presenters, their agents, representatives and employees for any loss or damage you may suffer in any way associated with your attendance at this presentation and or as a result of not seeking independent financial or tax advice. So a bit nasty that we need to do that kind of thing nowadays, but anyway, let's keep going. So what we'll talk about today are the 7 common mistakes investors make. There will be opportunities for questions and there is an attendee offer at the end. So a little bit very quickly about what we do here. So we are a specialist advisory firm with expertise in finding what I call high-performing investment-grade properties for clients and helping people to find the right property for their budget. Terry's touched on some of my qualifications. I am a licensed estate and licensed buyer's agent, an accredited property investment advisor, best-selling author, media commentator, and you can see some of the awards that I've participated in. But as Terry said, the reason I suppose I do what I do, first and foremost, sorry, I've jumped the gun a little bit there. First and foremost, personally, I have made a mistake over the years before I got into property as a profession of taking advice from selling agents, which was biased and often detrimental from my financial position. And at the time, my feeling was that there was really no one out there when I started my property investing journey 25 years ago to give me the support that I needed to represent my interests in the transaction. So primarily I do what I do because I don't want investors to suffer financial losses as a result of thinking that sales advice is qualified property advice and then mistakenly acting on it. And most investors have only got one chance to get it right, so it's important that they follow the right path in the process to doing that. Personally, I want to level the playing field between buyers and sellers of real estate, and that's by providing unbiased advice. And this also goes to resolving issues like underquoting and overpaying for property. And then we also want to support and educate buyers of the best method of investing, and it's about taking a logical and analytical approach. And again, this is designed to reduce risk and maximise returns to investors. So this is why I actually wrote my book, Property Prosperity. as a result of seeing too many people making those poor investment decisions, and of course as a result of that costing them tens of thousands of dollars, and often after they've purchased it and when it's too late to do anything to fix it. So that's just a little bit of a summary of the approach that I take and some of the mistakes that we'll talk to tonight. And I'm really proud to announce here today actually that my book has been modified into a property advice course for the financial planning sector, and it's to teach them how to integrate unbiased property advice into their practices so that they can better guide clients using my methodology to make smarter investment decisions. So that'll be released to the marketplace shortly. Now, an investor's journey. So let's talk about the investor problems that often lead to mistakes. So what I'm finding I'm coming across when I talk to clients or prospective clients is that they're frequently susceptible to property spruikers and developers, particularly talking about self-managed super fund investing and offering one-stop shop solutions. So they can make mistakes being involved with that. They're susceptible to buying poorly performing assets. There are frequently time-poor business owners or professionals who just simply can't get into the market. So again, they make ill-informed choices. And too many mum and dad investors think that all property is a good investment, and this often comes down to the fact that selling agents have had decades to oversimplify and dumb down the property buying process. So what they've been doing is they've been teaching consumers how to buy the property that they want to sell, and they've been telling consumers that these are the reasons why you want to buy it, and often that information is obviously not unbiased. So investors also have problems of being a bit information anxious. They can feel overwhelmed because there's too much information out there. Sometimes they don't know where to start, what to buy, or where to buy it. And of course, there's conflicting advice in the marketplace, and that leads to confusion and decision. And what I find is more often than not, if you look at the underlying advice, always go back to, well, what are they trying to sell me? And then you'll be able to get a better indication as to whether or not that advice is biased or unbiased. Again, people are being misled by underquoting, and they can often pay too much for property as a result of that. And most people don't know the difference between free advice, which is what I call sales advice, and independent professional advice. And often there are people out there that think that they can transfer their skills in their professional life to property investing. So I come across someone who's maybe pretty smart at their job, and they might do some element of negotiating as part of it, and they automatically think that I'm good at negotiating, so I can transfer those skills and I'll easily be able to get a good outcome. And if you don't understand real estate law, then that's where mistakes can be made as well. So what we're going to do today is look at a case study of two investors. These are genuinely two clients that I've worked with. We've got Bill and Sally. They were both in their 50s, they were married, and they have a low-risk investment profile. They wanted to generate some equity and cash for retirement. They gave themselves a 10-year time frame, and they had $400,000 or $410,000 to invest, and they decided to do it on their own. They don't look very happy. I don't know if that's because they're married or not, but nevertheless, that's Bill and Sally. Then we've got Stephen. He was 35, single. He had what I call a moderate investment risk profile. He wanted to build a portfolio for financial retirement, and he had a 25-year time frame, and he actually had roughly $800,000 to invest, and he wanted some advice. So we'll go down, progress down the presentation, and then see how they both turned out towards the end. Now, mistake number one. It's often thinking that free advice is good advice, and in case you're not aware, the property industry is not regulated by the Australian Securities and Investment Commission. So there's actually no legal requirement in Australia to need to be qualified to provide property advice, which means any person can call themselves a property advisor, and then it comes down to a case of buyer beware. So the way most people buy property is they'll either join investor clubs for supposedly wholesale discounts. They'll often attend education seminars for expert tips, but they may only get edutainment instead. And what I mean by that, there's lots of music and hype and urgency to act now, and it can be very misleading by the nature of the seminar and how they present it. Then, of course, people read magazines and property books, but sometimes it's only half the story. They talk about what to do, but they don't talk about what not to do. Then you've got your property institutes, your coaches. You know, sometimes they can charge $10,000 for education, but there's no actual guarantee of an outcome if you don't act on the coaching that you're getting. Then, as we all know, you've got property developers, project marketers, property spruikers in the marketplace. And then frequently people are referred by their mortgage broker, their financial planner or their accountant to a lot of project marketers. And you may or may not be aware, but these referees are often paid kickbacks or commissions. And sometimes they can make an enormous amount of money that they can almost sell their client down the river, and there can be dire consequences as a result of that. So another example of this is obviously referencing free advice isn't free. So if we look on that left side of the chart here, you've got the property selling model, and this is what happens when you talk to a selling agent or a project marketer. They will make property recommendations, but it will always be prejudiced and biased advice. Often is free, but it's what we call a property model because they're giving you advice with a view to selling you the stock that they have that they want to, sell and make a commission on. Then if we look on that right-hand side of the chart, we talk about the advice model, which is what I call a buying model. So that's about receiving independent and unbiased advice. It is fee for service. You will pay for that, but you will have a strategy tailored to suit you. And then it's about that advisor going into the marketplace and finding property to match your strategy. So people often think free advice is free, but at what cost? Not understanding that sales advice is not property advice is really important, and sometimes that free advice will often lead to poor capital growth. It might be the opportunity cost of missing out on a boom in the market while you're holding a poor performing asset. It could be that you lose equity or savings, and it could be that your portfolio development is halted as a result of not getting the returns that you expected, and therefore you can't build the portfolio that you want to. So then the next mistake is not understanding risk, and this is the extent to which you would be prepared to expose yourself to a particular level of loss in order to make a particular level of gain. So there are two types of risk. There's your personal risk profile, and that could range from being low to moderate, high to very high from a personal investing perspective. And then there's property risk associated with the property type and the zoning of that particular property as well, and that can determine a risk level. So, for example, with residential property, there's high risk and low risk opportunities. Most people don't know that buying properties off the plan can be high risk, and buying things like high-rise apartment blocks can be very high risk because you potentially have oversupply. Off the plan properties may not be built, or you may have developers go bust or builders go bust or timelines that aren't met. And then this often can be a higher level of risk to, say, buy an established property, and then if you want to take a developing strategy, that's usually a very high level of risk, and most people don't understand that if they've got a low risk personal risk profile, it might not be a good idea to invest in a high risk strategy because you probably won't sleep at night. And then if we talk about things like commercial, industrial or short stay holiday property types, well then they can often be higher risk because they might have limited resale. So it's really important that when you're buying real estate that you understand that one size doesn't fit all. And it's really important that you understand your personal risk profile so that the property that you buy or the strategy that you follow will match that, and then you can comfortably sleep at night. So if we look at mistake number 3, it's not having a documented strategy. So it's the old saying that failing to plan is planning to fail. And so many investors that I speak to, they don't have clarity around their goals, and those goals may not be realistic. They may not have a time frame, and they may not have considered the particular outcome. So it could be that they want to buy a property, but they don't know the purpose of that property. They don't know what that property is going to grow to. They don't necessarily think far enough in advance to know how much money they're going to need if and when they want to financially retire. So then they're not working backwards from that particular point. So part of that could be they're not considering their age, they're not considering their income or their cash flow, their risk profile. And there's something called risk appetite, which most people don't know about. And that's your desire to buy a property. So often I'll come across a couple where one of the people in the relationship's happy to buy 1 or 2 and the other party wants to buy 10. So automatically the appetite of one investor is higher than the other. And if you're not on the same page, particularly in a relationship, there can be conflict there. So you need to factor that in as well. Understanding how much you can cash flow on any shortfall per week is important. So you really need to know that if you're going to be negative gearing, or how much you're prepared to pay out of your pocket each week, and then that will actually go towards determining the purchase price of the property. And then the other really important factor is that most people get confused around whether they're investing for capital growth or cash flow. Often they say they want both, but you distinctly need to make a decision one way or the other, because that will obviously have an influence on the type of asset that you buy. And ideally, you've also got to know in advance what not only what your entry strategy is, which is to buy a property, but how you're going to hold it. Who's the tenant that's going to want to buy that property for you? And more importantly, who's the buyer at the end when you want to exit out of it? Is it a property that someone's going to want to buy from you easily, or is it something that you might be stuck with? So it's really important to have an understanding and a strategy around that. And, you know, often people hope that it'll all work out with time, but that's a really risky way of purchasing property, because it's not time that determines the outcome, it's planning and strategy that determines the outcome. So then if we look at mistake number 4, this can be about not engaging experts. And the reality is that experts cost money, but often not engaging an expert is more expensive than engaging them if you're going to make a mistake. So typically I'm up here, I'm one of these first people that we usually speak with an investor if they're looking to purchase a property. And what I say to investors is that, all right, well, I can help you with the strategy and put together the property, but you also need to have spoken to a broker. You need to have your finance approval in place. You need to understand your investment structuring, and it needs to match the size of the portfolio that you want to develop. And at the same time, you need to have seen your accountant or financial planner to make sure you've got the right tax structuring and entity structuring in place to match your long-term goals, so that when you do buy a property, all of that's ready to go and you're not actually buying it and then going back for advice, which is often too late. Same thing, before you sign a conditional or an unconditional contract, you want to make sure that you've reviewed that contract and had a solicitor or conveyancer look at it and give you advice on it, because after the event is often too late. And if you're uncertain about pricing and you want some guidance, well, then you can also engage a licensed valuer to give you an indication of price points as well. That may not be what you buy it for, but at least it'll give you an indication if you're struggling with figuring out how to price property. Then once a conditional contract is signed, or certainly before bidding at auction, again, part of your risk mitigation, you want to engage a building or a pest inspector. They're there to give you an indication of if there are any substantial costs associated with the property purchase, so that you're going in with your eyes wide open. It never ceases to amaze me how many times I buy property for clients, and most people don't do this. And I had an auction on the weekend that I went to, and we managed to get the inspector in just before the auction. And before I started bidding, he was busy telling me that there was between $50,000 and $70,000 worth of structural problems on the property, which meant we didn't proceed on the day. And yet we were the only ones who did the inspection, in spite of there being obviously substantial issues with it. So really important to do that. Sometimes you've just got to suck it up and pay the money. Better to spend $500 than buy a lemon and have $50,000 worth of problems. So the next step, once you have purchased the property, if it's an investment, then you do want to engage a property manager. They are licensed estate agents. They know tenancy laws, and they can protect you from issues and making mistakes, because often if owner-managers will go to a tribunal, magistrates frequently don't have tolerance for them, so you can find yourself in trouble. Certainly you want to get an insurance broker on board to make sure you've got your landlord insurance. And then after you settle the property as well, you want to make sure you've got a quantity surveyor to help you get your building and pest inspection report. So yes, all of this costs money, but it's designed to maximise return and reduce your risks. So the next thing we want to talk about is mistake number 5, not doing adequate research. So most people think that research is Googling, getting on the internet, having a look at realestate.com and starting to search for property. That's called searching. That's not called research. So it's really important to understand the growth drivers and what they are and how they affect your investment, basically, or your opportunity for growth. So you want to look at macroeconomic factors, and these are things like population growth, supply of property for sale, employment opportunities in infrastructure. And then you want to drill down further into what we call microeconomic factors, and that's local amenity, home buyer demand versus investor demand versus tenant demand, and then what's the balance between all of that. So most investors understand demand, but they neglect supply, and this can lead to common mistakes. So yes, population growth is a growth driver, but you don't want to look at that alone. You've got to factor in multiple growth drivers. People think that you want to be as close to the city as possible or in the city. Well, supply issues could be that that's not necessarily the smartest move. And often investors make the mistake of investing for tax benefits like depreciation or negative gearing. That shouldn't be the reason to invest. That should be a benefit of investing. Your reason really needs to come back to, are you investing for capital growth or cash flow? And then understanding local planning changes. These can make a really big difference. And if you're not aware of what's going on in particular areas, then you can pay a hefty price for that. And I'll give you an example of that further down the track. And then, does the property have the right combination of all of these factors to hold its value during a downturn? So again, you want to consider all of that, not just some of it. All right, so picking the top performer. Now, should you buy in the area with the best performing house prices? This is often a bit of a rookie error that people make in the research sector, because they think that it's about buying in the area that had the highest growth. And if we look at this example in Victoria, in December 2010, the highest performing suburb was Beaumaris. If we jump forward 5 years later, you can see that the highest performing suburb is Ashwood. So if someone's bought a property in Beaumaris in terms of that being the highest performer, 5 years down the track, it's not even in the top 10, and they'll possibly be looking at what the hell's going on, because they've made a decision based on historical performance, not based on growth drivers, infrastructure development, and what's going to happen in the future. Now, interestingly enough, 5 out of these top 10 suburbs in Victoria have been influenced by a lot of foreign and Asian purchases. If and as that slows down, then that will obviously affect the growth in these particular suburbs, and who knows what's going to happen down the track. These could no longer be in the top 10. So it's understanding what's driving market forces at the time, and then making a decision as to whether or not it's appropriate to buy in those suburbs for those reasons. So then let's have a look at mistake number 6. It's about not understanding the rules of purchasing, and often failure or success is down to the negotiation. So if you don't understand underquoting or how to appraise property or how to do comparable property analysis, you can leave yourself vulnerable to paying too much or even missing out on property. And if you don't have experience negotiating on property price and terms and conditions, then you can make substantial and costly mistakes there as well. So most people don't necessarily know how to formally present an offer to an estate agent to force their hand and have them present it to the vendor. And that can be a rookie error, because you're showing your hand, but you don't necessarily even know if the agents actually followed through with that offer. They can be playing you. And again, if you don't have a buying or an auction bidding strategy in place, you could actually miss out. And as we all know, there's no prize for coming second. So bidding at auction isn't just about sticking your hand up. It's understanding, you know, what the pricing is, what the pricing under competition might be. It's understanding how to read the other bidders in the audience that are bidding. And so there's a lot of complexity that goes into it. And if you don't understand the rules of going about it, you could find yourself doing a whole lot of work, spending a whole lot of time, energy and money to get to the point where you're bidding at auction, but you're missing out and you may not understand why. So either learn what the real estate agents learn, or you might want to consider getting some help in that area. And then if we look at mistake number 7, well, people don't review their portfolio annually. Most investors think property investing is set and forget, and it's a really dangerous position to take. And the reason is markets can change rapidly. So supply and demand factors in particular suburbs can change, employment opportunities and infrastructure activities can change, and population growth can change as well. So these can actually work for you and against you. So it's really important that you keep an eye on what's going on every year in the market where you bought, to help you make a decision as to whether or not it's appropriate to keep hanging on to that property or to sell it. Now, sometimes people make the mistake of falling in love with a property, and it makes it harder to sell if the market turns bad or the property is not performing. So it's really important to treat it as a business. And then also holding onto a poorly performing property without any evidence to support that decision, in the false hope that things will improve, can also cost investors thousands of dollars in lost equity or capital growth. And if we go back to Bill and Sally, that's a case study, an example that I'll show you now to explain or expand on that. So just a reminder, they had a low risk profile, they had a 10-year time frame, and they had $410,000 to invest, whereas Stephen had a moderate risk profile. He had a 25-year time frame. He actually wanted some help, and he invested $800,000. So let's look at what happened with Bill and Sally and what can go wrong. So in their case, they bought an off-the-plan apartment, which is high risk, and they didn't understand that, and they paid $410,000 for it in 2010. I did an analysis of that property for them in 2013, and at that time it indicated a $390,000 price, and the growth drivers as such was that it showed very little opportunity for capital growth moving forward. So they basically got a reality check around the fact that the property had lost money and it didn't look like it was going to recover, and were they going to sell or were they going to keep it? Well, in their case, they couldn't wrap their head around taking a loss and selling, so they hung on to it. But as more and more properties came into the market because of an ongoing supply of stock, they actually had to drop the rent to try and lease it. And then while it was negatively geared, they actually had such a low income that they really didn't get much benefit from a tax deduction. In the end, the bank required them to sell it. I helped them with that. We sold it in December 2015. At the time, I appraised it for them at $360,000, and they ended up accepting an offer of $355,000. So that was a further $35,000 less than if they had have sold it 2 years earlier. So this is what I was saying: poor asset selection and the wrong strategy in this case cost them effectively a $70,000 cash loss. And on top of that, if they had have taken their money and invested in a better asset, then that's roughly $60,000 worth of lost capital growth opportunity that they've missed out on as well. So really sad for them that that's the position that they're in, but this is such a common thing, and that's the importance of why I'm highlighting mistakes that people make. So this was an example with Stephen, who engaged our buyer advocacy services, and in his case we bought him a house in 2014 with what I call a high land value in a particular target suburb, and I usually buy with a 50 to 70% land value component. We paid $760,000 for it, and then 2 years later it's now appraised around the $975,000 mark. So he's made 28% capital gain in 20 months. It was really easy to lease to the market before settlement. He's always had a tenant, it's never been empty. It's been renovated, so he's got good depreciation. He happens to be able to afford to have it negatively geared. But more importantly, by really good asset selection and the right strategy, he's made $250,000 capital gain in 20 months. So again, highlighting the importance of understanding what those mistakes are, and doing everything you can possibly to mitigate risk around that. So just a quick little summation. I've probably whizzed through that a fair bit, so we've got plenty of time in terms of questions if anyone would like me to go back and retouch on any particular mistake. Just quickly to reiterate what we do, well, it's about helping people find investment grade property, helping clients find the right property for their budget, doing all the negotiation with the estate agents to get the right result, ensuring our clients aren't misled and don't overpay, and we analyse client portfolios and provide reporting to help you make a decision around whether or not it's an asset that you'd like to hang on to or whether you might be better off selling it. So on that note, does anybody have any questions further to any of the mistakes that we've gone through that I'm happy to go back and expand on or reiterate?
Okay, Miriam, thank you very much for the presentation, and I again remind people listening that if you do have questions, you can type those questions into the panel on your screen, and I can put those questions to Miriam. And we have a question which relates to your comments about the importance of being prepared to engage experts and spend money on the investment project. And just a general question, what's a reasonable budget? How much money should you put aside for the process of engaging accountants, buyers agents, planners, the various experts that you need to have on your team?
Sure. So if we go back to this chart, Well, your accountant and your financial planner, they'll usually charge an hourly rate, and I suppose it depends on what you're wanting from them and what advice they're going to give you. So when you meet with them, just ask them how they charge. It may be that you have one meeting, it might cost you a few $100s, but you know you're walking out buying the property in your name, or you know you need to set up a family trust, or you know you need to buy it in a company, whatever the case may be. Same with your financial planner. If you're buying a super fund or outside of a super fund, they'll quote you in terms of what they charge. And the same with the buyer's agent. Most buyer's agents, not all of them have got investment expertise, but they'll have a different level of service. They might do the whole thing for you. They might help you do it partially, or they might just do the bidding component. So depending on how much help you do or don't want will determine their fee. And mortgage brokers don't actually charge. They're usually paid by the lender. Coming down to solicitors and conveyancers, look, fees can range just for the full purchasing process. They could charge between $600 to $1,000 and above if they're a solicitor for that. Some of them may review your contract for free. Others may charge you $100 to review it, and then they'll offset that when you actually purchase the property. Licensed valuers, look, they could be around the $400 to $700 mark, again, depending on who they are. And then your building and pest inspectors, an apartment will cost less than a house. And again, everyone will charge differently, and they'll provide a different level of service, but maybe allow between anything from $400 to $600 per property on that, but ask for a quote. Your property manager, they'll charge obviously a percentage or a flat fee per annum, so you talk to them about it. But look, at a minimum, if you're going to DIY and do it yourself, you need to at least allow, say, $1,000 for conveyancing, $500 per property for your inspections, your building and pest inspections. So allow for maybe 2 of those if you don't buy straight up, and then everybody else will be subject to what they quote you. And look, it could be in some instances that you might pay thousands of dollars for the help that you're after. But I guess I look in this instance with this client here, he would have paid thousands of dollars getting all of that expertise from all of those experts, but he's ultimately ended up with an asset in the right structure and the right entity with the right tax benefits and the right capital growth. So given the result that he's got in that time frame, I actually don't think he cares. So it's really about understand the value of what these people deliver for the fee that they're going to charge you. And look, there's a little bit of truth in that pay peanuts, get monkeys, but at a minimum investigate it and understand the cost of engaging them, but more importantly understand the cost if you don't engage them.
Okay, Miriam, a question from James, again relating to the services you provide, asking, can you clarify how your business makes money from helping clients, although the case study of Stephen would be an indication of that. He's also asking, typically such services are a percent of purchase price, which can be a prohibitive overhead, and also asking, are your costs tax deductible?
Okay, so sorry, what was the second part of that? So how does someone like me make money? What was the second question?
How does someone like you make money for your clients? The second part of the question is, are your services typically a percentage of the purchase price, and are they deductible?
Got it. Okay. So again, everyone is different in terms of how they charge and how they work, just like lawyers and accountants and dentists. So you need to interview people on a case-by-case basis. Personally, I'm in this category, where are we? Trying to find the right little chart. So I'm in this category here, where I'm a buyer's advocate. I provide independent and unbiased advice, but people will pay me a fee for service. Personally, I charge a flat fee, not a percentage, and so that gives people peace of mind. And depending on the service that I do for them, will determine whether or not the fee is tax deductible. So my understanding is, and again, you need to seek your own accounting advice, but if you have an existing investment property and you were to engage my services to buy another one, the buyer advocacy component of it is what's called a capital cost. It's not tax deductible against your income, but it does come off any capital gain when you sell the property down the track. But what I do is I provide an advice component in what I do, and that percentage of advice is deductible against someone's income. So again, case by case, not everyone's qualified to provide advice. They may just give you an invoice that's 100% buyer advocacy, and then that will dictate whether or not you can claim it. But if it's for your own home and you're buying a property for your own personal use, then my understanding is no, you can't charge those fees.
Okay, a question from Han. What would you say are the main growth drivers at suburb level?
Well, again, it comes back to these microeconomic indicators. So you're talking about, I've got to find the right one here. Yeah, so you're talking about, well, what are the local amenities? You know, how many schools are there? What are your employment opportunities locally? You know, is there public transport available? What's the shopping like? What's your proximity to all of that? Is there a lifestyle component to are there cafes? Is there a cafe strip? And then it's a mix of, well, what's the supply like? Are there lots of apartments in the area? Are there no apartments? Is it 60% owner-occupiers in the area? Is it 40% tenants? So it comes back to that home buyer demand, investor demand, tenant demand, and understanding, looking at the balance of all of that. So look, this isn't easy stuff. It doesn't take 5 seconds to do. And this is why if you don't have the confidence or the expertise, because it's often not what you know, it's what you don't know, this is where you might want to seek help with all of that. But obviously that's where Terry comes in and he provides reporting, and then it's a case of getting out there and doing more of your own research.
Okay, a question from Pramendra. He's asking, is buying property in Sydney overpriced and will the price of house likely to fall? I'm aware that you are having a lot of Sydney investors now looking to Melbourne, which is partly a response to that question, I think.
Yeah, well, look, definitely I do work with a lot of interstate buyers, and particularly people are finding themselves priced out of the Sydney market. It's fair to say that it's probably reached its peak. Will prices fall? Well, a lot of it will come down to asset selection. You know, if I go back to that example of Bill and Sally and you know, getting it wrong versus getting it right, when you're talking about a suburb or buying in an area where you've got a massive oversupply of stock and there's more coming into the market and people aren't renting it, well, in this instance, this is a perfect example of how that property has fallen in value regardless of external market conditions. So if you look at data, it will often say at the moment that St Kilda East has been one of the top performing suburbs for the last 12 months, but it will always come down to what you buy, where you buy it, what the street is, what the land value is, and other factors, as I've already mentioned. Again, if we go to someone like Stephen, where I bought this particular property for him, will this go down in value? Well, I highly doubt it, because if it's an investment grade property, it's usually the first type of asset to accelerate during a boom, but it's also the type of property that will hold its value during a downturn. So a lot of that comes back down to asset selection, which is really important, that you understand the mistakes that you can make and do everything possible to mitigate all of those risks and those mistakes.
Miriam, Amanda is asking what areas that you cover, and asking, does Property Maven operate Australia-wide?
I'm not Australia-wide. I work in Melbourne Metro and regionally. I buy a lot of property for Ballarat, depending on clients' budgets and strategy. I do have a network of REBA, Real Estate Buyers Agents Association members. We all work to a particular code of conduct and ethics, and I do have buyer agents interstate in every state, more or less in Australia, that I can refer people to if they would like to buy interstate. But definitely I've got, you know, Melbourne and regional Victoria covered if anyone needs help locally here. And look, to answer that question before about is Melbourne a better place to invest, what's been really interesting, if you look at the 2015 Australian Bureau of Statistics, in terms of Melbourne's performance and opportunity to continue to perform, we've probably had the highest employment levels of any state. You know, obviously we've got a lot of infrastructure and development going on here, and we've got projected forecasts of population growth that at some point in time, probably around 2050, will actually start overtaking Sydney, simply because we have the capacity to keep building out and up, where obviously Sydney's restricted, you know, being surrounded by a mountain range. So, yeah, so sorry, that was just to add to that question from before.
A general question from John about research, and just asking the question, understanding the importance of research, but where do you go for information? There's so much information. What can you trust? What can you believe? How do you do that? Very, very time-consuming and difficult process.
Well, it is. That's exactly right. And there are research houses out there that all have different methodologies to determine their outcome, and there's no legislated or regulated way that everybody has to do their research to come to a conclusion to get the same sort of result. So this is it, it's about really searching what's out there. And as I said, Hotspotting does research. There are paid, you've got the likes of CoreLogic, RP Data, and different organisations out there that all do research. But because of that methodology, you can get the same data from 3 different organisations and they're all saying 3 different things. So that's where you might want to start looking for some expertise or some help, or doing some more of your own study around the sort of things to take into consideration. But again, try and keep it simple. Try not to get too caught up in analysis, because that's where it is confusing and it is overwhelming. Sometimes it is coming back to the basics, and the basics are microeconomic indicators, macroeconomic indicators, drilling down to an area, drilling down to suburbs, and at some point in time, you've got to trust that you're making an informed decision and take action. And if you don't feel that you trust your own decision and you need help, well, then go and get some help.
Okay, I just follow up from your point, Miriam, about the conflicting data. I recently did an exercise in comparing 4 different major name sources on price growth in capital. And there often is absolutely no commonality. It's quite common to have a situation where one source will say prices are rising in a particular market, and other sources will say they're falling, or the degree of growth can be as bigger variances between 2% or 10% or 15%.
Exactly.
How do people make sense of that kind of nonsense?
And that's why it is confusing, Certainly, to a degree, there's a lot of noise out there, and you've got to know where to switch off. And I think if you look at the major fundamentals around growth drivers, and then once you've nominated the suburb, it will come down to looking at prices and looking at making sure you're doing proper comparables, just to see what's been happening over recent timeframes, and if in fact there is accelerated growth for the right kind of asset, or if it's not performing at all. So, you're right, Terry, there's a lot of conflicting data out there, and that's part and parcel of, why you do what you do and what I do, and we're trying to find solutions and provide solutions for people.
Okay, Sammy's asking a question based on the fact that he has an investment unit and not sure how long to keep it. Can I engage someone like you to assess it? How much would that cost, and will the fee be tax deductible?
Okay, so yes, that is very much a service that I offer. It's called a property portfolio report. There's some. I'll actually flick to the next screen. I've got an offer for you all. But just in relation to this particular question, if you'd like to go to my website under services, just there, it'll drop down as property portfolio report. I will do a full analysis on your property for you. It'll give you an indication of opportunity for capital growth and whether or not it's worth keeping or selling. You obviously need to make your own decision. I charge $995 for that, and yes, it should be tax deductible because it's for an investment property.
Okay, Peter is asking a general question about the immediate future of the Melbourne market, referring to recent publicity that the market may have peaked or be past its peak, and asking what your view is in terms of future growth in the Melbourne market.
Well, I don't have a crystal ball. No one does, so no one should ever be projecting what future growth will or won't be. You can only look at the data at hand and make informed decisions accordingly. Certainly, a couple of years ago, everyone was saying that Melbourne had met its peak, and of course it's continued to grow in that time. And certainly the property that I buy for clients, there's always competition for it, and I'm scrambling to get that investment grade property, and I'm fortunate that I buy a lot of it off market. So if it's the right asset, regardless of where you are in a cycle, if you pick the right asset, you're in the market. If that cycle starts taking a downturn, well, the right asset will hold its value. And then when that cycle picks up again, it'll start accelerating in growth or in value. And you've got to remember that property is not a short-term investment. It needs to be a medium to long term. So if you're trying to pick cycles and get in, get out and flip and trade, well, you're taking a trading mentality, and there's obviously risk that comes with that. But if you're taking the right medium to long term strategy, then to a degree, you know, yes, it might be smart to buy counter-cyclically, but you've got to do all the research to try and figure out where that is. Or you can buy in a city where, like Melbourne, for example, people might be buying at the top of the market, or it might be not quite there yet, but it's about, if you're not in the market with the right asset, you're never going to get the growth, and take that medium to long-term view.
James earlier asked some question about costs and processes, asking a follow-up question about what recourse people might have in extracting themselves from arrangements that don't work, and asking, is this a contract law or a property law area?
Sorry, could you just repeat that, please?
Sorry, yes. James is asking what recourse people might have in extracting themselves from an arrangement, sales advocacy, for example, arrangement doesn't work. And a second part to that question, is this a contract law or a property law area?
Okay, so I'm guessing you mean vendor advocacy or sales advocacy. It really comes down to whatever the agreement is that you've signed. It's a property law area. You'd want to be dealing with, I suppose, a property lawyer and seeking that advice, because real estate law is different in every state. Agency agreements are different in every state. And different, buyers, buying agents, selling agents will have choice around what they do or don't use. So I'd suggest go back and read carefully what you've agreed to. Look at the time frames in it. Best case scenario, see if you can negotiate a mutual agreement to step out of it for whatever the reason might be. You might get a yes. If not, seek some legal advice around how you can get out of it. And it may otherwise be that you can't. You just have to wait for the time to pass and let it become void, or let it expire.
A question about your comments about reviewing your portfolio, and the question is, what would a portfolio review actually entail? What sort of things do you look for, and what factors do you examine in the properties in your portfolio to make an assessment of what you should do with them?
So I'd look at things like land supply, I'd look at growth drivers and employment opportunities, I look at population, I look at asset type. So I look at a number of variables, and it usually ends up with a 20-page report. But then I also do cash flow modelling and look at people's income and what the property's actually delivering from a return perspective against their income and their taxable position, and then I provide conclusions around that. But again, if you go onto my website and click on services, it'll drop down and say property portfolio review. It's got more information on that if you'd like to know specifics. Okay.
Sam asked the question, I'm not quite sure I understand it. The question is, the Chinese-driven suburbs of Melbourne, how can they be conflicted in future? I'm not quite sure what...
I don't know what conflicted means. I don't understand the question.
No, I don't understand it. Sam, perhaps if you're listening, if you could clarify by typing some further information, we can respond better to that question.
So while we're waiting for the next question, if we just look at what's on the screen now, I'll just get rid of that. So anyone who's attended the webinar today, I've got 3 little guides. They're all a mini version of my book, Property Prosperity. You are welcome to download those guides for your own records. You just need to go onto my website, www.propertymavens.com.au. Go to the little resources section and it will drop down. It'll give you a drop down, and this is where you can click on here, Property Buyer's Guide, and then click to download, and basically you'll have a summary of everything that we've gone through today, and it'll talk a bit more specifically around some of those mistakes.
Okay, we don't have a clarification of that question, but we do have another question. What factors do you consider when buying from a mortgagee auction?
Well, first and foremost, does it meet my criteria to be investment grade? You know, you've obviously got to do an analysis around whether or not it's the right asset to buy. Mortgagee auctions, well, they'll always go to auction generally on the advice of a lawyer. And I wouldn't treat it any differently to any other property that I've purchased, so long as it's got the right fundamentals and right attributes. I would simply be attending the auction. I would have done all my comparable analysis, knowing what similar properties have sold recently for in the area. I'll have a bidding and a strategy in place with my client, and then I'll attend with the view to purchasing on that basis. But I will have set a budget. I always set a limit with my clients that we just don't go over. That stops the emotional component getting in the way. I don't buy emotionally anyway because I'm representing a client. But we have all of that absolutely clear before I'll actually attend the auction and bid on the day.
A question from Simone. Given that you're a buyer's advocate in the Melbourne area, is it worth getting a property portfolio review from you if my properties are based all over Australia?
I actually do analysis for properties based all over Australia. So the way we do our research, we have the ability to access information regardless of where the properties are located to be able to do the report for you.
Okay. Well, we still have a little bit of time, Miriam, but...
Okay, that's fine. Well, what I'll do while we're waiting for some more questions, so as I've said, feel free to download those ebooks. Alternatively, if anyone wants some help buying in the Melbourne metro area or in regional Victoria, I'm more than happy to offer a complimentary consultation to anyone who might like to take me up on that offer. So it's just a case of going onto the contact section of my website and then hitting that little drop down under contact for free consultation, filling in the form, sending it through, and then I'm happy to get in touch with you and see how I can assist you.
Okay, Vera says, Miriam, these mini guides can be downloaded by anyone from your website. Do you give the full e-version of the book for the attendees?
No, I don't. You're welcome to buy the book. I don't give away all of my IP for nothing. That's incredibly valuable information, so you do have to pay for it. You can actually purchase it on Amazon in the Kindle version. You can purchase it on my own website, and that would be under resources as well. So if you're clicking on the little resources tab for your guide, you'll actually see there that there's also, where is it? There's also under this tab here, it says book. So you can click on that and you can buy it directly off my website. And if you buy it off my website, you don't pay for postage, and I'm happy to autograph it for you. And it's only $29.95.
And I could say that, Miriam, that it's a $30 well spent. So I've read many real estate books in my time. Most of them aren't worth the paper that they're printed on. It's very rare to actually come across a book that's both extremely well written, contains good, solid, simple advice, isn't telling people that they can become property millionaires in a very short space of time, but it's just basic, good, sensible advice on how to undertake the investment process successfully. It's very rare to find a book like that, but Property Prosperity fulfills all those criteria for me, which is why I've been happy to write a testimonial for the latest edition.
Thank you, Terry. I appreciate that. Being a journalist yourself, I'm very chuffed that you feel it's well written. And just to give everyone a bit of a better understanding, I actually originally had a background in financial services. So I take a financial services approach to direct property investing, which is why I talk about things like what's your risk profile, what's your strategy, are you trying to buy for capital growth, you're buying for cash flow, bring in the right experts and all the rest of it. So if you do follow those steps in that order, then you're giving yourself really the best possible chance to get the outcome that you're after. But it's also because of that approach that I'm taking and because of the quality of the book that I've been fortunate to partner up with a registered training organisation to teach 16,000 financial planners around the country how to better support their clients when it comes to investing in property. So the idea is to take that content of that book and show them how to look after their clients rather than letting clients wander off into the ether and then be subject to all of these problems that we spoke about earlier. And look, making a poor investment decision, you've seen here what's happened with Bill and Sally. You've got two choices. It can be potentially devastating, or you can get no growth, or you can do extremely well. So I'm here to educate and help consumers to try and do everything possible to help them get the best outcome possible, and hence why I wrote the book.
Another question has come in from Michael, who says, most of my property investments are in South Australia and some have not performed very well. Would you suggest selling and reinvesting in, say, Victoria? I know it's very, very difficult to answer a question like that without having great knowledge about the individual properties, but is there some sort of...
Look, I can't answer that question. It comes down to what are the reasons it's not performing. Is it, and this is why I do the portfolio reviews, because it's about drilling down, doing a detailed assessment, looking at those factors that will influence a property's ability to grow in value. And then you make an informed decision as to whether or not to keep it or to sell it. If you do sell it, if it's not performed or you're making a loss, well then obviously the next step is let's look at you reinvesting that money wisely. How long or what's the time frame to potentially coming back to break even? Because if you're selling at a loss, well, you want an asset that's going to perform and bring you back to that break even point. And then from there, it's about being in blue sky. So I can't answer that question because I just simply don't have enough information around your situation to do so. But feel free to ask for a free consultation. I can get some more information from you that's more specific to you and we can have a chat about it.
All right. Time's almost up. Just before I wrap up, Miriam, people who want to follow up, interested in perhaps engaging your services or seeking some advice or just generally asking further questions, what's the best course of action? I think the answer is now on the screen.
Yeah, so you can go on the website and, as I said, request a free consultation. That'll allow me to capture, obviously, your details and set aside time to specifically call you. Or you can shoot me an email. We've obviously got a phone number. But if it's something that's going to require a bit of time, probably the free consultation is the way to go. And otherwise, feel free to download those guides. And by all means, I'd love it if you bought the book and be more than happy, as I said, to autograph that for you and help you have a better outcome from your investing.
Okay. Well, Miriam, thank you so much for a very articulate and very well-informed presentation. I found it educational. In particular, I concur with your views on the importance of people willing to engage experts, have a team of experts on their side as they undertake the process of property investment and be willing to spend money to make some money. I think it's true that all of the truly successful property investors that I know are all people who are willing to spend money before they actually invest in real estate. They're willing to spend money on research and on expertise that they can engage before they make any decisions that involve the spending of $500,000 or more in their investment dollars. So that for me was a reiteration of a very important message that I wish that more property investors around Australia would take on board, because I encounter too many who say they're willing to spend $500,000 but are unwilling to spend $50 on a research report or $500 on a valuation to make sure they're paying the right price.
Yeah, and look, it's really important that everyone understands that I've been doing what I've been doing for nearly 20 years, and you can't necessarily go online or attend a course and learn what I've learned in 20 years in the course of 5 minutes. So it's mainly about risk mitigation, making sure you're not making an expensive mistake, because every time I've seen someone in financial distress or with an asset that's not performing, it is absolutely because they've made one of these mistakes that I've referred to. So they haven't got the right experts, or they haven't had a clear strategy, or they haven't understood the difference between unbiased advice versus biased advice. So experts are there for a reason. Everything that they do requires expertise and a lot of knowledge, which is why you pay them. You know, you might think you're saving $500 on a building and pest inspection report, but every time I get one back that says, look, this is going to cost 10 grand to fix or 50 grand to fix, or I'd be walking away from it, my client has just saved themselves making a a $500,000, $900,000 mistake. And it was spending that $500 that enabled them to not make that mistake. So, yeah, it's good advice, Terry. I totally agree with you.
Yeah, it's certainly false economy not to spend the money. So again, thank you for a wonderful presentation, both articulate and very well informed. I hope all of you people out there listening got some value from it. Please be aware that everyone who registered for today's webinar will be receiving a copy, a recording of the webinar, and please follow up with Miriam if you have further questions or are willing an interest in taking advantage of some of the services she provides. So this is Terry Ryder saying thank you, Miriam, and over and out to all the listeners today.
Thanks, Terry. Bye.